Imagine investing in a fund so safe, it's backed by the government itself. Welcome to the world of gilt funds. These funds are a type of debt fund that invests primarily in government securities, offering an attractive mix of safety, liquidity, and returns. As these securities are issued by the government, they carry virtually no default risk, making gilt funds one of the safest investment options available. Now that we've piqued your curiosity, let's delve into the structure of gilt funds. A gilt fund structure is like a fortress built on the foundation of government securities. Now, if you're wondering what a gilt fund is, let's break it down. A gilt fund is a mutual fund that invests primarily in government securities, making it inherently safe. But what's the primary investment objective here? Well, it's twofold. One, to generate steady returns by investing in government securities, and two, to provide investors with a relatively low-risk investment option. Now, these government securities could be central government bonds, state development loans, or treasury bills. These come in all shapes and sizes, or rather maturities, offering a choice of short-term, medium-term, and long-term investment options. So the next time you hear about a gilt fund, picture a fortress, robust and risk-averse, built on the solid foundation of government-backed securities. With such a strong foundation, it's clear why gilt funds are a safe investment. But what about the returns? Let's dive into that in the next scene. In the world of investments, there's no gain without some risk. But with gilt funds, the scales tip towards safety. These funds invest in government securities, making them virtually risk-free when it comes to credit risk. After all, the government is less likely to default on its debt obligations than any corporate entity. That said, the returns on gilt funds are moderate. They're not designed to make you a millionaire overnight, but to provide a steady, predictable income stream. These returns are influenced by interest rate movements and the current economic climate. Here's the catch. When interest rates rise, the price of existing bonds falls, causing the net asset value of gilt funds to drop. Conversely, when interest rates fall, bond prices rise, and so does the net asset value of gilt funds. So gilt funds offer a balance of safety and returns, but how do they manage interest rate risk? Navigating the sea of interest rate fluctuations can be tricky. But gilt funds have a compass called duration management. This strategy involves adjusting the fund's investments based on the anticipated shifts in interest rates. But what exactly is duration? It's a measure of the sensitivity of a bond's price to changes in interest rates. In essence, the longer the duration, the higher the interest rate risk. If interest rates rise, the prices of bonds with a longer duration will fall more significantly than those with a shorter duration. Conversely, if interest rates fall, bonds with a longer duration will see a greater increase in price. Gilt funds use duration management to mitigate this risk. By adjusting the duration of the portfolio in line with interest rate forecasts, the fund can position itself to benefit from potential rate changes, or at least minimize potential losses. With effective duration management, gilt funds can weather the storm of interest rate changes. From their solid structure to the balance of risk and returns, gilt funds are a worthy addition to any investment portfolio. With their primary objective of investing in government securities and their ability to manage interest rate risks, they offer a secure option for investors. Remember, understanding taxation and regulatory aspects is vital to maximize returns. So invest wisely with gilt funds and see your money grow safely. Subscribe to our channel for more insights on investments. Until next time, this is Mazuma Master signing off.